how does Vega relate to correlation in options trading? Have you ever wondered how Vega impacts your options trading strategy, especially when dealing with multiple assets? Understanding this relationship can make a big difference in managing your risk effectively. Let's break it down step by step. First, Vega measures how sensitive an options price is to changes in implied volatility. This means that for every 1% change in implied volatility, the options price will change by the amount indicated by its Vega. If an option has a high Vega, it means its price will react more significantly to shifts in volatility. Implied volatility reflects market expectations about future price movements of the underlying asset. Now let's talk about correlation. In options trading, correlation refers to how the price movements of two or more underlying assets relate to each other. If two assets are positively correlated, they tend to move in the same direction. Conversely, if they are negatively correlated, they move in opposite directions. When you are trading options on multiple assets, understanding the correlation between these assets is essential. The overall volatility of your options portfolio does not just depend on the volatility of each individual asset. It also depends on how those assets are correlated. For instance, if you have two stocks that are highly correlated, an increase in implied volatility in one stock will likely lead to an increase in the other. This can amplify your Vega risk. Now, how does this all tie into risk management? When you manage a portfolio with multiple options, you need to be aware of how correlation affects your overall Vega exposure. If the correlation between your assets changes, it can alter the expected combined volatility. This means you may need to adjust your positions to manage your Vega risk effectively. For example, let's say you hold options on to stocks that are highly correlated. If implied volatility rises in one stock, it is likely to rise in the other as well. This situation increases your total Vega exposure, which means you may need to hedge or adjust your positions to control that increased sensitivity to volatility changes. In summary, while Vega measures sensitivity to implied volatility for individual options, correlation plays a significant role in how volatility behaves across multiple assets. Understanding this relationship helps options traders anticipate changes in combined volatility and manage their Vega risk more effectively. By adjusting positions based on shifts in correlation, traders can maintain better control over their portfolios and navigate market changes with confidence.